TDX Stock Research. This report is automated and updated in daily financial and economic data. Suzano, company in the specialty of paper products subsector. The rating is neutral. Keep in mind that these reports are dynamic and rating could change daily, weekly or monthly, depending on the changes of the financial conditions of the company and economic data. Suzano in its financial structure shows, in its long-term assets a reinvestment rate about 1,281%. The return of investment capital ROIC shows, a performance of 2.6%, and if we compare this return with its cost of capital WACC it's minus 4.9%, so the company need to improve the cost of financing its assets. The EBITDA give us an idea about the financial liquidity of the company, which is $2,724 million. The productivity of long-term assets in comparison with revenues is 32.92%. The return of the EBIT after taxes versus the cost of financing 100% of its assets is giving an economic value added EVA near minus $1,440 million in the current report, and the change this EVA versus last EVA was negative. EBIT should increase in the future, in a rate about 33% if the reinvestment rate performance equal to ROIC, otherwise should performance, at least as his actual operative margin. The EBITDA margin shows us that for each dollar in sales, the company is generating 0.41 cents of dollars in cash. The productivity in working capital shows us that for each dollar in sales, the company has to invest $0.28 in working capital. The company has a growth lever of 1.45, which means that this company is attractive for a sales growth. The structure between shareholders, equity and liabilities is not balanced. The trend in sales last year's has increasing. The trend in EBIT last year's has been decreasing. In a linear scenario, we expect an uptrend behavior for the next years in revenues and neutral for EBIT if maintain the same trend. The free cash flow valuation per share is negative. The relative valuation is in $11 per share. Summarizing, the company has to improve its financial structure and must improve its ROIC, return of invested capital. The rating is neutral. This stock could decrease 12.33% in midterm scenario, if maintain the trend in the net income, and maintain the actual dividend policy based on capital. The fair price based on WACC, lack positive free cash flow, for this reason the share could very strong. This stock is 2.3 times the price book ratio. PE ratio is minus 14 years for the net losses. Level 1 shows us that dividend policy is on speculation side. Level 2 show us in speculation signal, the net income side. Level 3 show us that the company is neutral, building value in relation with its assets per share. An intangibles versus equity relation up to 80% could be a risk factor, in case the company enters in a liquidation status. This relation now is 97%. The three forecast scenarios per share are based on its historical volatilities and show a aleatory return scenario of the portfolio for next 16 months. The rating of this report will change automatically, while the changing of interest rates, risk primes, financial statements, economy data, generating an impact in company's financial structure and sensibility in the valuations. All these in order to be accurate to find investments opportunities.